Today, the Federal Reserve voted to lower interest rates by 0.25%. However, there's much more to the story than just the headline. Here's why. In their second to last meeting of 2025, the Federal Reserve, as predicted, lowered federal interest rates, also known as the Fed fund rate, by 0.25%. But the future of rate cuts before the end of the year and into 2026 are where things get much more complicated. The Fed relies heavily on economic data to guide their decisions. With the ongoing government shutdown, key data points such as unemployment, inflation, and price data have been, for the most part, suspended. Despite this data blackout, the Fed likely leaned on recent layoffs by major companies such as Amazon as a sign of a weakening jobs market, which provides good reason to lower federal interest rates further. While the headline of a rate cut was good news for investors, the stock market still dropped in the wake of today's announcement. As tariffs and layoffs continue to weaken our economy, the Fed is tasked with trying to make crucial decisions in the dark. Avoiding further rate cuts will weaken labor markets even more, increasing the damage that is being done due to tariffs. However, continuing to cut rates with minimal data on the current state of the economy runs the risk of sending inflation sky high, also largely due to tariffs. These fears were confirmed by Fed Chair Jerome Powell, who stated another rate cut in December is not a foregone conclusion. So, while investors still contend with the short-term uncertainty of the economy and federal interest rates, there are longer-term fears as well. As we enter 2026, Trump will gain even more power over the independent central bank, including the power to install a new Fed chair when Powell's term ends in May. Follow for our ongoing coverage of the stock market, economic events, and more.